At his historic town hall meeting last month, Fed Chairman Ben Bernanke said, and I quote, "I was not going to be the Federal Reserve Chairman who presided over the Second Great Depression," end quote. My guest today, Bob Prechter, Chairman and CEO of Elliot Wave International, says he may be counting his chips too fast here. So, Bob, you think Bernanke is claiming victory before the war is won against deflation?
Well, Bernanke's a smart guy, and he's got his reasons for believing what he believes. But all of the charts that I study, and that includes the stock market, the commodity markets, and also the extent of indebtedness that we have in the society, they all paint the same picture. And it's one reason why I took the risk to write a book several years ago called Conquer the Crash, and the subtitle mentioning a deflationary depression ultimately happening. One of the things that we talked about in that book was the idea that when the deflation hit, you would see stocks and commodities and real estate, all three of those major investment areas, all go down together, and also stressing at the same time a number of the debt instruments that were out there.
Right.
That is exactly what
we've had so
far.
Right. Didn't we have that in 2007, 2008, or the last half of 2007?
Right. And if we had readings that said we were at any kind of major bottom for any of these investments, I would say, yeah, maybe that was it. But if anything, we're still historically overvalued in the stock market. We've had one of the biggest drops in the price of oil, I think the biggest in the amount of time ever, 78% in a matter of months. A lot of commodities broke and told us that this was the beginning of the great deflation that we were talking about.
So that's clear. That was the beginning of the deflationary cycle, not that we've already lived through it. That's your point here.
That's correct. And the commodities have completed wave counts that go back decades. This isn't something that's just a setback and we're going to go into new highs again. Now take a look at another thing. The Fed and the government were inflating as hard as they could all through the decline, and yet week after week the market went lower and lower and lower. We got to a point where we reached an intermediate extreme. We were able to recognize that. We've now recovered enough in the commodities and the stock market pretty much to say that that's over. We've had the same thing happen in the dollar. The dollar has come down, which is what the Fed wants, a weaker dollar.
They sure do. Yeah.
But now I think the dollar has bottomed. We had the same psychology in the dollar last week as we had in the stock market on the 6th and 9th of March. That is how important this low in the dollar is. And that tells me that the next big phase is a credit implosion, where the people who are debtors are going to be scrambling for dollars to pay off their debts, and the creditors are going to be dunning the debtors to pay themselves back. So the scramble will be for dollars, not for things.
That's very interesting, because it seems, again, the conventional wisdom is that all the stimulus that the Fed has done and the U.S. government has done are just starting to catch, and we prevented the economy from going into free fall, and now we're on the road to recovery. Again, what is telling you fundamentally that that's wrong?
Well, first of all, isn't it interesting that in the second week of March, none of that was true? Nobody thought anything was catching, so they have to stay away from the stocks. Don't touch the commodities. They're all bottom. They're all making lows, but nobody wanted them. And of course, now there's a story to cover why you should be buying stocks after a 50% rise, 340 S&Ps up, and with oil having doubled from its low and all the commodities having recovered. This is how markets work. They give you a story at the bottom and a story at the top. So I don't pay any attention to these except to help confirm that people are convinced, from their reason, which I believe begins with the wrong premises, but reasonable arguments for why they should be buying after the markets are way up.
Right. So walk us through, before we wrap here, what you see this deflationary cycle is going to look like. You talk about a scramble for dollars. Is the U.S. consumer right here to be ratcheting up their savings rate? Are we going to be able to do enough savings to take advantage, for lack of a better word, of this deflationary cycle?
Well, whether the consumer is right or not in saving, we predicted unequivocally that they would start saving more, and that has been absolutely true. We also believe that the biggest area of overvaluation because of credit extension is the real estate area, and if you'll notice, that's the area that's had the weakest of any kind of attempt at a recovery. People still are having extreme difficulty selling homes here. So I would say that the march toward depression, which is being fueled by the deflationary trend, is pretty well intact. We also predicted a moderate, recovery in the economy after a few months up in the stock market. It's pretty classic that that's the way it occurs. The economy lags the market, and we're seeing that now. So far, we've been pretty well able to predict times when people would be more optimistic and the reasons that they would be. So as yet, I don't feel that we've been fooled on any of these moves in the last few years, and we'll just have to see how this one plays out.